Hey everybody, Hot Dog Boy here. Today I'm going to talk about why I decided to short TLRY at the price of 138.25. These weed stocks have been going absolutely nuts recently. I've been keeping up. Basically, all this tension is building around October 17th when Canada makes weed recreationally and medically legal throughout all Canadian territories. And these companies are expecting a huge bump. So TLRY in particular has been doing insanely well. It's been up several 100% over the last 3 months or so. If you look towards October 17th, many companies are gearing up to try to take advantage of that new market opening up. Specifically in this video, I'm going to talk about TLRY, CGC, that's Canopy Growth Corporation, and CRON, that's Cronos Group. All three are in similar markets, and they all have medical products and recreational products on the way. The Canadian population is only 35 million people. So about 28 million of those people around are above the age of 21. So unless you sell those people a ton of weed, it's not going to work out. These companies are going to destroy each other over a very, very small market. If we make the generous assumption that 25% of those people are going to consume these type of products, and the generous assumption that those people are going to spend $1,000 a year on these products, that's still only $7 billion in market cap. Right now, you have TLRY at about 13.5 billion market cap according to the stock price. CGC is at 11 billion and Cronos is at 1.7 billion. So why did I specifically decide to short TLRY and not CGC? Well, if you look at the gross profits, all gross profits is you take the profit from the product sold and you subtract just the raw materials to make that product. So it doesn't include marketing, doesn't include sales costs, any of that. Right now, Cronos and TLRY are both around. TLRY has 4.2 million and Cronos has 6.3 million in gross profit. So Cronos has a little bit more. Compare that to the market cap. TLRY, with that $4.2 million profit, has a 13.5 billion market share. Cronos is a 6.5 million profit, so significantly more, with a $1.7 billion market share. So if you're buying TLRY, you're paying a premium for that stock. Cronos is a much better buy in this situation. Personally, CGC is the best of all three. CGC is profiting 4.2 million, and again, that doesn't count marketing costs. If you consider marketing costs, we'll get to that a little bit later. They're all not making any money. Cronos is making a little bit of money, but CGC and TLRY are making net negative operating income. So if we look at CGC, we have a gross profit of $42 million, so that's exactly 10 times more TLRY, but their market cap is only $11 billion. So this shows me the stock price is massively inflated. And you might ask, all this hype over all these weed stocks, why is there more hype over TLRY than these other companies? Because they're all hyped up, but specifically TLRY just seems to be exploding to insane levels. That might have something to do with these beverage deals floating around. So shareholders are looking to find the next weed stock that a beverage company is going to pick up. There's been rumors floating around that Canada is going to start selling these weed-infused beverages. That'll be something like a beer, where you'll go into a bar and you'll get a beer-like drink, but you get high off the drink instead of drinking the alcohol. So a lot of people think these are going to be very, very big, and Constellation Brands, they're the company that owns Modelo and Corona beer, so very, very big. But 38% of the market share in Canopy Growth back on August 15th. On receiving that news, Canopy Growth stock price jumped 25% in one day. TLRY hasn't got a beverage deal, but there are constantly rumors floating back and forth that TLRY is talking about getting a beverage deal with lots of different companies. PepsiCo has been in there. New Age Beverage, which is founded by some ex-Coca-Cola executive, and I think it's Neptune Beverage or something. So there's all these beverage companies floating around, and people might think they'll form a deal with Tilray, causing the stock to just pop right up. Personally, I don't think that's going to happen anytime soon, because right now Tilray has a massive, massive overvalue, as we were talking about before when we looked at the balance sheets. If I were a PepsiCo executive, or if I was a New Age beverage executive, and I saw Tilray right now, looking at this balance sheet, I would say, no, there's no way I'm going to pay that much for a share of your company. I'm going to wait for your company to tank, and I'm going to pick up the stock when it's $10 a share instead of right now when it's like $150. So that just doesn't make any sense. So when would I pull out of my Tilray short? So again, I bought it at 138. As of right now, it's, let me see, it's at 146. So I am off by about, let me see here. Currently I'm in the red about 6%. I'm not too worried about it. I know eventually it's going to come down. On September 20th, Tilray had its biggest spike. At one point, it touched $300, and it opened a little bit over $150. So after that day, I felt pretty comfortable shorting because I saw the peak. And I am now fairly confident that Tilray is not going to get that high again. And anytime it gets around 150, it gets very, very bloated, and there tends to be a little sell-off afterwards. So just the psychology of buying Tilray, at least in the short term, it doesn't seem like it's going to spike up very much, because once it gets around that 150 mark, another sell-off happens. And it's not going to climb any higher than 150, or between that 150 and 300 range, there's going to be a sell-off, because there was in that day. And a lot of the people that invested when Tilray was climbing around 250, 270, 280, they lost their shirts that day. Millions and millions of dollars were lost, because if you bought at 300, it closed close to 150. So a lot of the big money investors, or the people that were just throwing down big money into Tilray, those people have long since been scared off. And there's still plenty of them around, but not anywhere near as much as there were before September 20th. So I really am not afraid of a run-up, and I'm willing to keep my money tied down into Tilray, at least until these two dates. One of them being November. So November 27th, November 14th, and November 13th are Tilray, CGC's, and Kronos Group's earnings dates, respectively. So these dates, more numbers are going to come out, and we'll get to see this kind of fantasy breakdown of all this hype around weed stocks. And then when these numbers come up, we'll see more operating losses and how much profit these people have been making since the October date. And I really think the fantasy is going to come crashing down. Provided that doesn't happen, and I still don't make money on my short, I'm going to wait until January 15th. So January 15th, all the institutional investors that bought Tilray stock, which it IPO'd around $17. So often if you buy before as an institutional investor, you might get a special price. So these people bought their stock at about $17, maybe even a little bit less than that if they got a good deal with the insiders of the company. And now, again, the stock being around 150, if I was one of those institutional investors, I would be licking my chops, because you can nearly tenfold your money if you were able to sell right now. So that January 15th date, I anticipate there's going to be a big sell-off. So if I don't make my money by mid-October, I don't make my money off November, I'm going to hold off until that January date. My price target right now is around 110. So I'm hoping to sell at 110 and then, buy to cover at 110, and then honestly, if it climbs back up, I'll probably hop right back on that train. From shorting at 138, I don't think it was a mistake, but I know that because it's jumping up around 150, I could probably get back on the train a lot higher and keep making money on the way down every single time. So I'm pretty excited about shorting Tilray. What else do we have here? Oh yeah, so we look at the CEOs, just a quick comparison between those three companies. Tilray CEO's name is Brian Kennedy. He's around 46 years old because he started college in the 1990s. Then we have Bruce Linton of CGC. He's around 50 years old. And we have Cronos's Michael Gorenstein, who's only 32. So just, I looked these guys up on LinkedIn. All of them look pretty successful. Michael Gorenstein being 32, which doesn't have anywhere near as much experience as the other guys. And he doesn't really have doesn't look like he has any experience running a big company. Whereas Bruce Linton, he doesn't have quite as much executive experience, but it looks like he's been involved in lots of different political groups in Canada. He was part of a trade commission in Canada, so he probably knows how to work his way through some regulations and business, and I'm sure he has lots of connections in Canada. Brendan Kennedy, he's been in weed just as long as Bruce. Bruce has been in CGC since 2012. Brendan Kennedy's been with his company since 2011, and he was doing some software companies before. But yeah, so both CGC and Tilray's executives have a little bit of edge over Cronos. Another thing on the balance sheets that really stuck out in me was if you look at the SG&A value, that's the sales, promotion, and delivery. So this number represents how much money is going into those things, how much money the companies are spending to get their salesmen to sell their products, to advertise, and to actually get the product physically out the door and to the customer. So if you look at our gross profits, the gross profit is just the raw materials expense subtracted from the money made from selling the actual product. That doesn't include any of these other expenses. So the sales sales, promotion, and delivery values do include those. And at first glance, it might look like Tilray is a big advantage here, because if you look at operating income, so the operating income is that gross profit we were talking about before, and then you subtract research and development, and then your sales costs. The operating income for Tilray is, as of last quarter, negative $10.9 million for the quarter. And for CGC, it's negative $28.8 million per quarter. For Cronos, they're the only one with a net positive of $490,000 up for the quarter. So Cronos is the only one currently profitable. It's got a 910 PE, so that's pretty insane. But still, I guess better than no PE at all. So at first glance, we're looking at this and saying, oh, why does CGC have so much operating costs? But here's the catch. CGC is spending $36.8 million on sales and promotion to Tilray's $8.9 million. So the reason why CGC is running at such a higher loss is because they're spending 4 times as much money advertising. So when October 17th happens and that Canadian law snaps into place and those gates open, CGC has been investing nearly 4 times as much money, and that's consistent if you look back through the last 4 quarters. So what I anticipate is going to happen if the crazy CGC up and down prices don't get me in the green and trigger my my buy order to cover the position, the gates are going to open up on October 17th, and CGC is going to come out screaming with all that advertising revenue, and they are going to wipe out the rest of the market. I really do think that's going to happen. Personally, I wouldn't buy CGC right now either, just because, again, assuming 25% of those Canadians that are above the age of 21 consume those products, and assuming each of them spends $1,000 a year on the products, which I think is a little bit generous, that's only $75 billion worth of yearly revenue you can scoop up. So all these companies are dramatically overvalued, and come October there's going to be a bloodbath where all these inflated giants are going to fight over a very small amount of market share, and Tilray is gonzo, trust me. So let me know what you think in the comment section below, and I'll see you next time.